Lambert.
Thank you. So thank you for everybody for joining today. This is Janet Lambert, the CEO of the Alliance for Regenerative Medicine. Today we're going to try to give you some access to some experts on the new coronavirus support programs that have been passed by the Congress and signed by the President of late. And try to give you some tools you can use as we all try to navigate this new world that is this pandemic. I think many of the attendees on this call are members of ARM, but there are some who are not. And so I want to make sure you understood what ARM is. We're an alliance of folks who care about getting safe and effective regenerative medicines to patients around the world. Regenerative medicine in our lexicon is cell and gene therapy and tissue engineering. We have about 350 member organizations, primarily small pre-revenue companies of the sort that I think are probably most interested in some of the programs we're going to talk about today, but also nonprofit research institutions, patient groups, and other sector stakeholders across 25 countries. We work on a whole set of policy issues and scientific issues that are meant to advance the sector as a whole. In terms of specific COVID resources, we've launched this webinar series, and I'll talk a little bit later about the next one in this series, which will be a conversation with the FDA and those folks who are providing guidance on clinical trial changes in the context of the pandemic. We've built out a COVID-19 resource library that's available at our website. We're tracking those regenerative medicine development programs that are relevant to the virus. And we have added a kind of COVID-19 section to our weekly sector news roundup for folks interested in the latest developments. On the whole, we're trying to, in this strange time where we can't convene in the way that we normally do, continue to provide resources and opportunities for folks to learn from experts and from each other. And so really that's why we're here today. And these are the experts who have graciously agreed to spend some time with us. Michael Werner, as many of you know, is the co-founder of ARM and our senior policy counsel. He's also the head of the life sciences practice at Holland Knight and has helped us draw some of his colleagues in to talk about these special loan programs in particular. Joel Roberson joins us, Nicole, Elliott, and Mary Beth Bosco. And what we're going to try to do today is to talk through, as the title of the webinar suggests, these new emergency loan programs. Really, what is now available to companies in terms of support during this pandemic, and also what are the new support programs for employees. We've heard from a lot of our members that they're struggling both to figure out how to manage their employee population and provide accurate information to their employees, while also trying to understand these new programs that are available for the companies themselves. We'll leave some time at the end for your Q&A. Michael Werner's going to kind of sort that through. There's a system for offering and asking questions. We ask you to use the Q&A system here in Zoom in order to ask those questions, and then we'll kind of sort them and process them and ask the questions of our panelists this morning. The webinar will be available later on ARM's website, so if you feel there's some information here you'd like to share with colleagues, that would be the easiest way of doing it. So with that, let me turn it over to Nicole, who is going to kind of walk through some of this information about resources available to you.
Good morning, everyone. Give me just a minute to share my screen. And you should all now see the Holland Knight presentation that we're about to give. And I'm going to, as we discussed, we'll be covering a lot of the new provisions with an aim towards employers and employees, and particularly in covering what has Congress done and what has the administration done as a result of COVID-19. Joel?
Thank you, Nicole. My name is Joel Roberson. I'm a partner at Holland Knight in our public policy and regulation group. We represent clients. I work with Michael Werner, and we represent clients that in front of the federal government, including the administration as well as Congress, and are going to walk you through some highlights related to the federal response to COVID-19. As you heard, there is a Q&A portion on the Zoom call at the bottom. So as you hear this presentation, please feel free to enter your questions. We will handle them as we go or reserve some time at the end. But to provide an overview, Congress has taken three primary actions responding to the COVID-19 pandemic in the United States. These started with a piece of legislation passed at the end of February that provided $8.3 billion in emergency funding to public health agencies. This is NIH, FDA, CDC, Department of Health and Human Services, to try and inject funds, as well as to the states, inject funds in trying to address the immediate public health crisis. They followed that by passing the Families First Coronavirus Response Act, which moved then to protecting employees that might contract COVID-19, might be treating or caring for a loved one who has COVID-19, or maybe dealing with a situation where their children are out of school as a result of COVID-19. It provides some associated tax credits we'll talk about, as well as expanding access to free COVID-19 testing. The latest federal response to COVID-19 was the CARES Act, which you've probably heard a lot about. This injects $2.2 trillion in economic relief to individuals and employers. What's important here is this is the largest relief package that was ever passed by Congress, and it was written in about 7 days. It was a rush, recognizing that the stay-at-home orders and the shelter-in-place orders that were happening around the country were having a devastating impact on our economy, and it's an attempt to try and respond to that as quickly as possible to provide companies with liquidity, as well as to protect employees. The CARES Act does a lot, but it certainly doesn't do everything that's needed for the economy to weather this economic and public health storm. And Congress recognizes that. Congress has already started drafting a fourth economic response bill. There was a thought that fourth bill may start to transition from economic relief into infrastructure spending or job creation. Recently, Speaker Pelosi and the President have acknowledged that the economic impact is going to continue well beyond the $2.2 trillion that were already extended. So we're likely to have another bill passed at the end of April or into May that provides further economic relief to companies like yours and others that are experiencing disruption based on COVID-19. So we'll next start to walk through what some of these federal funding opportunities are for you, describe those opportunities, and talk in a little bit more granular fashion as to how the funds can be used and how you can become eligible. So if you advance to the next slide, there were 4 primary federal funding opportunities that were included in the CARES Act, and we'll go through each of them in turn. The first is the SBA Paycheck Protection Program, which is the forgivable loans. This is probably the program you've heard the most about. There are 2 other SBA programs that were addressed by the bill, as well as a $500 billion coronavirus economic stabilization fund, which is being created by the Treasury Department. And the Treasury Department is still rolling it out. So it is important to note here that each of these federal funding opportunities have a different set of eligibility requirements and have different conditions on how those funds can be used. So you have to look at each one and your company's particular needs specifically, so that you can understand which is the best opportunity at the most attractive rates for the best term, and that can be used for the acute needs that you have when it comes to liquidity. It's also important to note that you may have existing debt service or debt obligations, which could impact your ability to take one of these loans from the federal government. So you should definitely make sure you're talking to your in-house counsel or outside counsel if you need to, in order to better understand how they would impact your business. So the first program that we'll dive into here is the SBA Paycheck Protection Program. This was, Congress provided $34 billion towards this program. It is a brand new program that was created under the CARES Act. And the key here is that if you use the funds that you are given appropriately, these loans are 100% forgivable, meaning that you don't have to pay them back. They convert from a loan, which is required to be repaid, to a grant. The maximum loan limit for the SBA Paycheck Protection Program is calculated based on your payroll costs. It is, as the name would denote, it is an intent to protect people's paychecks. So the vast majority of the loan amount, the eligibility, the permissible uses are based off of your ability to pay someone to the paycheck of your employees. So your maximum loan amount is calculated based off of 2.5 times your average monthly payroll costs. Payroll costs are listed there on the slide, but they are intended, the payroll cost is intended to be an all-in calculation with the exception of federal taxes, which are not included as part of your payroll costs. Once you receive that maximum loan amount or some amount less than the maximum that you request, you have 7 permissible uses, but it's important to note that on the next slide, we'll talk a little bit about the what the forgivable uses are, which is a smaller subset. But the interest rate, if you don't get 100% of the loans forgiven, the interest rates are at 1% payable over 2 years. So even if you end up using it for one of the permissible uses listed on this slide and not on a forgivable use, it's still a pretty attractive way to get liquidity for your company. It is important to note that the SBA did include in its implementation guidance that no more than 25% of the amounts can be paid on non-payroll costs. So they want the vast majority of the funds to be going towards payroll. If you can advance to the next slide, in order to have these funds that you receive under the Paycheck Protection Program forgiven, you have to do 3 things. You have to spend the money within the covered period. The covered period is an 8-week period beginning at origination of the loan. And you have to spend them, as I mentioned, on this smaller subset of forgivable uses, which is on payroll costs. Again, 75% has to be spent on payroll costs. Mortgage interest, rent, or utilities. So those are the forgivable uses. And the last catch here, which is really important, is you have to maintain your average full-time equivalent employment, and you have to maintain individual salaries and wages of at least 75% of what that individual was making prior to COVID-19 during that 8-week covered period. There is a provision there, understanding, Congress added this towards the end, understanding that the economic impact on your company may have required that you let some employees go before the bill was enacted and you received the funds. There is the ability to cure by rehiring employees or increasing salaries to get above the necessary thresholds to get 100% forgiveness, so long as you do that by June 30th. So it is a fairly complicated calculation here, but is one that is certainly doable. And if you do it, then you will be forgiven. But I'll turn it over to Mary Beth Bosco and our team to talk a little bit about eligibility for this program.
Thanks, Joel. I'm a partner in the Holland Knight government contracts practice, and that means I deal a lot with small business eligibility issues. One thing to stress is that this program is changing. The eligibility rules are changing. I think we are on our 4th clarification from the Treasury Department that was issued last night. So as you'll see on this slide, we've incorporated some of that information. So in order to be eligible for this loan, you have to have less than 500 employees, or your business has to qualify as small under your size standard, which SBA uses to otherwise determine who's small and who's not. And those are based on what's called your NAICS code, which is the North American Industry Classification System. Now, this is one of those changing pieces. Initially, SBA said that you could only use the alternate NAICS code calculation if your NAICS code was measured by number of employees. For example, if the NAICS code said you can have 1,000 employees and still be small. What changed last night is that SBA or Treasury is now saying that you can also qualify as small if your NAICS code is a revenue-based NAICS code. So for example, regardless of the number of employees you have, if you're in a NAICS code that says, say, you know, $10 million is your limit for being small, you qualify. If you're under 10 million, you qualify for small. There are a couple of exceptions to the normal affiliation rules. Probably the most prevalent is that multi-unit accommodation services such as hotels, et cetera, and food service businesses with less than 500 employees at a particular location can apply and are eligible, even if there are a number of different locations, right? So you don't aggregate the locations, you just, each location gets its own 500 employee limit. Next slide, please. You self-certify your eligibility by, when you submit the application, you need to sign it. And there are certain things that you are certifying to when you sign your loan application. The first is that you are, you meet the criteria. You meet the criteria for eligibility under the PPP program. Another interesting thing that you will certify to is you have to certify that the current economic conditions necessitate your taking a loan. We'll talk about that in a minute. Again, the guidance last night changed a little bit about what the lender's responsibility is in terms of the borrower's eligibility. And it came down pretty much on the side that the lender is permitted to rely on your statements of eligibility. Certification in the government contracts world implicates what's called the False Claims Act case, because you are submitting something to the government asking for government funding. A violation of that statute carries civil and criminal penalties depending on the offense. So we want to stress that because your certifications need to be made in good faith. Now, at the beginning, Joel said that there are a number of different loans in this package. Pre-existing was what's called an SBA Economic Injury Disaster Loan, or an EIDL loan. You can have an EIDL loan and still apply for a PPP loan. So they're not mutually exclusive. The only condition is that you cannot use the two loans for the same payroll costs and other obligations. Next slide. So for purposes of who's small, the question we get all the time is, well, who counts as an employee, right? So the biggest question is, who are your affiliates? Because if you are affiliated with another company, then their employees or revenue get, put into your bucket. So you and all your affiliates have to be less than 500. Now, an affiliate is an entity that can control you or you and other companies as affiliates, either through ownership or what we call control. And controls things like similar management, same people on the board of directors, voting provisions that give even minority investors blocking rights. So that's been one of the focuses of questions that we've had, is who's an employee. The other question that we have, because people are somewhat incredulous, is that the number of employees includes full-time and part-time employees. Each one is a separate employee. It's not a full-time employee equivalent. In most cases, when you are counting employee, your 1099s won't count in the calculation. So you can exclude those. Now, in order to calculate the number of employees or revenue, it's a, again, a trailing monthly average looking backwards. What we're telling everyone is that even if it is blindingly obvious to you that you qualify under these standards, you should still document and maintain a file showing that you went through this analysis. We believe that there will be significant oversight of this program. There will be audits. The CARES Act actually added a significant pot of money to the Inspector General for just this purpose. So this is where an ounce of prevention is really called for. Next slide, please. There are some other eligibility requirements other than the employee. The borrower has to be located in the United States, but you could have a foreign owner. So the intent of the act is to get to U.S. employees, which makes the ownership of the company irrelevant, if you will, because what we're trying to do is to get paychecks to U.S. workers. You had to have been in business by February 15th of this year, and your employees are supposed to be U.S. resident employees. We talked about the certification. A group of questions we also get relate to what do we need to do to certify that the loan is necessary to continue operations? What if other aspects of my business are impacted, but I don't think I have to make any payroll reductions, or I don't think I'm going to have to furlough people? What do I need to show? And again, we are telling people to think about, what else is impacted, make an inquiry, and then again, document how you came to that conclusion that it was necessary. For example, you can use some of the proceeds from mortgage interest, and if that's a burden on your company and this will help you out, that would be something that would certainly fall under the necessity bucket. Next slide, please. The Paycheck Protection Program, which is the loan forgiveness program that we've just talked about, is actually in addition to sort of an existing SBA loan, which is called the 7A loan. And so those eligibility requirements are tacked on to, if you will, the PPP requirements. So it looks, you have to list on the form not just information about yourself, but if you have owners of 20% or more in the company, they have to be listed. You have to certify that you are not suspended or debarred, that you have a clean criminal history, and that there are no delinquent taxes or child support. And again, we are reminding people that certifying to those items subjects you to potential civil and criminal penalties for false statements. Next slide, please. So In terms of how this is rolling out, it's been an interesting week or so. So the first loan application form and guidance was issued on March 31st. And as I have said, I think we are on either the third or the fourth level of supplemental guidance. So things change rapidly. Banks began to accept the applications on April 3rd. I should also mention that if you are an individual or an independent contractor, you can also apply for these loans. And that application process starts on Friday, April 10th. Again, on this slide, last night's guidance seemed to take out the foreign ownership prohibition. So again, if you've got a foreign owner, but you're in the U.S. doing business, you are eligible for these loans. Next slide. The economic injury disaster loans, or the EIDL loans, are what I just referred to, the precursor of PPP. The CARES Act provided $10 billion in addition to what's in that pot. Some of the differences between this and the PPP loan program is the PPP loans can be forgiven if you meet those requirements. EIDL loans do not. The maximum loan is $2 million. The maximum interest rate is 3 3/4, which is more than the 1% on the PPP loans. The maximum loan term is 30 years, so it's longer than PPP, and that the term is set on a case-by-case basis. Again, you can have both an EIDL loan and a PPP loan, but you can't use them for the same purpose. Next slide. SBA also has an express loan program where, again, you have to qualify as a small business in order to apply for these. They are supposed to be very, very quickly approved. Typically, or before this, they were capped at $350,000. The Act raises that number to $1 million. The maximum loan term is in between PPP and EIDL at 7 years. Next slide. The CARES Act also creates you'll see $454 billion new Treasury lending facility for distressed businesses. Now, this is what I think we've been calling the provision for medium-sized businesses. So you would be 500 employees or up to, I think, 1,000. And you will see how this compares with the small business loans we talked about. There's no loan limit. The interest rate is not capped. It's variable based on how the lender perceives risk. These are secured loans. Now, the PPP loans do not have to be secured, and you do not have to give a guarantee. And there are further limits on how these stabilization fund loans can be used. No stock buybacks, dividends, or capital contributions. And there are limits on also executive compensation, probably as a reaction to what some of the tax refunds under the Tax Act were used for. Next slide. And with that, I'm going to turn it over to Nicole Elliott.
Thank you, Mary Beth, and thank you, Joel. So far we've kind of talked about the different pots of money that might be available to you, either depending on your size and all the other eligibility requirements. And now I'm going to switch slightly the topics to tax provisions that were included in either the first, the second, or the third round of what Congress did in response to COVID-19. And then just to give you a preview, our kind of final big topic is what's available out there for individuals. So importantly, and this impacts both you as an individual taxpayer, as a person who has to file your 1040, and also as a business, one of the things that the Treasury Department did pretty early on was decided that to give people additional time, people and businesses additional time to file their income tax return and pay their income tax liability that would normally be due on April 15th. So you've got more time to file and more time to pay anything that you would have normally done by April 15th, and you've got additional time until July 15th. And there's no limitation on the amount that can be not paid. So if you had a tax liability and you just wanted to not pay it, you can do that without any fear of penalty or interest. And it applies to your 2019 income tax liability, as well as if you are a business, it applies to your 2020 estimated tax payments, income tax payments that would have been due on April 15th as well. This was about giving people more time, giving businesses additional liquidity. I would say that it only applies to income taxes, and it only applies at the federal level. So a lot of states we see have done something similar, but I would just urge you to check with your state to see what they've decided to do. So now I'm going to go on a couple of tax provisions that will specifically help employers, those people who pay wages and are trying to figure out what to do in this tough times. The first thing that Congress did was establish the employee retention credit. And this is something that existed prior to when we were dealing with Hurricane Katrina. And I like to think of this as the $5,000 credit that can be claimed. And this is for eligible employers. So any size employer, you know, we deal a lot with SBA with size 500 under 500, and we'll talk about that in some of the tax provisions, but employers of any size can take this. However, if you are over 100 full-time employees, the credit is less valuable, and I'll walk through that in a minute. To be an eligible employer, you have to have had a business that was interrupted or suspended due to a government order. And there is, I would say, on this, like the SBA and like what Mary Beth was talking about, we are still waiting on a lot of guidance. So we've had a lot of inbound questions about what exactly does it mean to be a government order? Does it happen if my supplier was impacted by a government order and then I cannot do something that I need to do? So it's still a little bit gray, but if to be an eligible employer, you have to be interrupted or suspended due to government order, or another way to be an eligible employer is you have to meet certain tests about a substantial decline in your gross receipts from 2019, and we can provide you with the test there. But once you're an employer, an eligible employer, you get to claim 50% credit on wages up to $10,000. So if you do the max math, that's $5,000. That's why I'm calling it the $5,000 credit per employee. And again, if you are over 100 full-time employees, it is less valuable of a credit because you can only claim wages for employees that were not providing services. So it would be a situation where you're still paying their wages, but they are unable to provide you services related to COVID-19. This employee retention credit is claimed against your 941 taxes, so your employer taxes that you would pay on a 941 quarterly. And interestingly, this, in addition to one other tax provision I'll talk about, it's advanceable. So this means that if you are struggling to meet wages, there is an opportunity to claim this credit in advance with the IRS and get a check. The delay of employer payroll taxes is also a really big deal and does free up a lot of liquidity. This is for employers who, of all shapes and sizes. And what it does is that normally employers would withhold the 6.2% Social Security tax, it's called the FICA tax, and pay it over to the IRS. So it's a 6.2% tax on wages, and it goes to the Social Security. That's how we fund Social Security. What the law says is that you don't have to do that anymore. You can basically delay payment, and you have to pay 50% of it in 2021 and 50% in 2022. So it's basically 6.2% that you get to keep in your pocket. And like I said, this applies to employers of all shapes and sizes, big and small. But importantly, if you are interested in taking one of those SBA PPP loans, the payment protection, the forgivable loans, what the statute said, and it is kind of quirky, and again, we're waiting for guidance, but it says that basically, if you are getting an SBA PPP loan, you cannot do this. You cannot delay the payment of your employer payroll taxes. And again, it's not a forgiveness, this provision that we're talking about. It's simply a delay. You can pay it later without interest or penalties. There are a lot of other tax provisions. Some of them will be more meaningful to some of you than others. And so I've kind of talked about those that I think probably are more relevant to you, but there are other lacks and liberalizations that happened in the tax code as a result of the COVID-19 response. One is related to net operating losses. That would be the Tax Reform Act basically disallowed companies from carrying back any losses and now we've kind of liberalized it, and now for losses in 2018, 2019, and 2020, you can carry those back. So there might be some businesses out there who can actually file for a refund because of this liberalization. It also, probably maybe particular to some of you, allows immediate write-off of qualified improvement property. That would be improvements made to commercial properties kind of inside. And again, that was kind of just fixing and thinking about, I think of these as a little more long-term in terms of solutions, and the ones that I spoke about earlier, more urgent and more about creating liquidity. But I just wanted to highlight that there are other tax provisions out there. And now we're going to switch to for employees. So while we were focusing more on employers, now we want to talk about, for those of you who are concerned about your employees and some of the options and the things that are now available. The first one I actually am going to cover, and then I'm going to turn it back over to Joel. And it relates to the tax code, but because there's a tax credit. But what the second round, what Congress did, and this only applies to you if you are less than 500 employees. So again, we're triggering a lot of this off of 500, but there are different ways to count. Unfortunately, what happens under the SBA rules doesn't always mirror what happens in the Internal Revenue Code. But for the first time, Congress passed a law that said, if you have under 500 employees, you are now required to offer paid sick leave of 2 weeks and emergency family leave. It basically expanded FMLA that many of us are familiar with to pay at a reduced rate 12 weeks of pay. And we can certainly send you additional information if you think you might be subject to these two new mandates. But the Emergency Family Medical Leave Act is mostly about people who now have to care, like myself, for kids who are at home. And the Emergency Paid Sick Leave Act, again, applies to employers of less than 500 and covers things like you have COVID-19 or you're caring for someone who has COVID-19. In light of these two new mandates, which will certainly be burdensome on some employers, there is $1 for, and it helps a lot of employees for sure. But the employers who have to pay for this now, what Congress did was create, again, another tax, a refund tax credit that's refundable and advanceable, like the employee retention credit, for those employers who are now have to offer their employees this additional benefit. But it should, I think, what was driving this decision by Congress was really about helping employees, and that's why we've included it in this portion of the slide. With that, I'm going to turn over to Joel to talk about a few other things available to employees.
Great. Well, we've heard a lot from companies as well, is that many companies have had to make the tough decisions to let some of their employees go as the economy continues to be impacted. And although there is significant both federal funding and tax benefits to try and increase liquidity, that is not enough to benefit all of your employees or employees in your industry. Congress also, recognizing that, also included provisions in the CARES Act to extend unemployment insurance and enhance unemployment insurance for employees that are directly impacted by COVID-19. You'll see on the slide, they've included 3 different programs related to unemployment insurance. The first extends 39 weeks of unemployment insurance to those that were not otherwise eligible but are directly impacted by COVID-19. The second and most significant that you've probably heard a lot about is they're extending for up until July 31st, an additional $600 per week to employees on top of what the states are already providing. So depending on what state you're in, this was the calculation here was based off of how to make the average employee receive 100% of their wages that they received before they were impacted by COVID-19. But that calculation means that there are actually some employees that will be making more than they were making when they were employed on unemployment insurance. So we're just flagging that for companies that there may be some incentives that come into play here when you're ready to rehire employees, that they are receiving a positive benefit from working from home or from being at home that may create some friction to rejoining the workforce. Every state in the country has entered into an agreement with the Department of Labor to start receiving those funds, so those funds are flowing in all 50 states. The last is providing 13 weeks of additional benefits for those that have previously exhausted their benefits. If you go to the next slide, there's just a couple other provisions we wanted to flag for your attention related to individuals. Nicole already mentioned that there was a delay in income taxes that apply to your business. That also applies to you as individuals and your employees as individuals. So you do not have to file your federal income taxes till July 15th, but if you are due a refund, IRS is encouraging taxpayers to file now because they are processing refunds, and that, again, would get you some money into your pocket. You've also probably heard that there are direct taxpayer payments. There's some details here. They phase out starting at $75,000 in income in your last tax filing, up to $150,000 for 2 individuals filing jointly. And we'll finally flag that for those homeowners, and these are residential homeowners, this does not apply to commercial loans or commercial mortgages, but if you have a federally backed mortgage loan and you can demonstrate that you're experiencing financial hardship due to COVID-19, there is the ability to request payment relief for that mortgage at no penalty to you. So just wanted to flag those in case you had questions about what is happening to employees of your business or your family or loved ones that had left the workforce over the last couple of weeks. So we'll advance, and with that, we'll allow Michael Werner to moderate some questions posed from you all. And just as a reminder, there is a Q&A portal through the Zoom function down at the bottom, so feel free to ask any additional questions you've been meaning to ask throughout the program.
Thanks, Joel, and thanks, Nicole and Mary Beth. That was really, really informative and helpful, and thanks for doing it. Just a couple of follow-up questions, or perhaps kind of honing in on a few details maybe for emphasis. So I think this would be for you, Mary Beth, but others on the panel should chime in. Many emerging biotech companies are VC funded, and that the implications of that are that the VC firm might be the financial backer of the company. It might be that there are members of the VC firm on the board of the company, kind of all shapes and sizes of this, but it wouldn't be unusual. And there's been some concerns expressed in the Washington community and around the country and the industry that when SBA looks at this issue of affiliation or control, that somehow the fact that you've got this, venture fund behind you that, influence, maybe on your board and all of those things, does that suggest that either when you're thinking about eligibility and of these programs that people in the VC firm have to be counted somehow as employees, or that other companies that are funded as part of the VC portfolio somehow now have to be counted? Can you talk a little bit if the SBA has kind of opined on this, and how you would advise companies to be thinking about this.
Sure, Michael. The typical scenario for a VC is that they're not going to be the majority owner. If a VC is your majority owner, then you are affiliated with the VC. Typically more, they're a minority shareholder. And so you have to look at the rights that the VC has under your shareholder or voting agreements. And particularly what we look for are things we call negative control. So if the VC representative on your board of directors, for example, can block an action that the company otherwise wants to take. For example, if even though a minority on the board, that one VC representative must assent to an action, that's negative control, and that causes affiliation. So what many of the VCs have been doing is looking at those types of documents, the board agreements, voting rights, shareholder rights, and if they have a control provision like that, and if they're willing to do it, they will either change the agreement to remove that condition completely, or they may also just put in a waiver that they can waive that provision. In the SBA guidance that came out last night, Treasury deemed that would be sufficient, that if they did that, they could avoid control. So I hope that answers the question.
No, that's great. And then another question I have, maybe this is for Nicole. You talked a lot about the tax credits, both obviously employer and employee. So kind of a threshold question, are these only for for-profit entities if ARM has members who are nonprofit organizations, for example, are nonprofit? Does this all apply whether you're a for-profit or nonprofit? The second question I have is, I think you alluded to this, you don't have to wait till you file like your taxes for tax year 2020, right? You can, there's a process for claiming some of these credits or funding now.
So yeah, thank you, Michael. So I also saw another question I was trying to chat with you, I wanted to answer that. So the first thing one of the things that I talked about is the new requirements that employers now have if you are under 500 to offer paid sick and expanded Family Medical Leave Act in certain COVID-19 kind of causes. The question was answered, isn't there an exception for under 50? There is. And I was trying to go through it very quickly, but if you are under 50 employees, you may not have to offer this additional paid sick and expanded Family Medical Leave Act. But the challenge there is that you have to be under 50 and you have to, it would jeopardize, the languages would jeopardize the viability of business as a going concern. And so we don't have yet a lot of guidance on, we know you're got to be under 50, but what exactly that means. And so that was an excellent question, and I apologize I didn't mention it. The tax credits that I spoke of, the employee retention credit, trying to get you to keep your employees, and if you have a tax credit now available to you because you were required to pay paid sick or expanded Family Medical Leave Act, we call these the paid sick credits, those do not have to wait until you file as a business your end of year income tax return. Those are credits against your employer taxes. So again, with your 941, that can be claimed there, and anything extra will be a refund to you. Or separate and apart, Congress did this crazy thing which said it can be advanced. So there's an IRS form 7200 that is out there in draft form. And so if you don't want to wait till you have to file your quarterly employer taxes, you can actually ask the IRS to advance those to you. Now I will say IRS has asked you to fax that form. So I'm a little hesitant to think that will work great, because I think what they're realizing is the person has to get the paper off the fax machine and cut a check. So I think it's a little unclear how the advancement's going to work. But you're absolutely right that it does not have to wait till the end of year. It was about providing money throughout the year so people would keep their employees on the ranks.
Thank you. The next question, this might be for Mary Beth, but I don't know any of you can answer. So just a little, you talked about this, I think, but it bears repeating. So just some very practical things about the loan programs. So you go to the do you go to the SBA? Do you go to a local bank? Are there particular banks, that are specializing in this that you have to go to? Just a very kind of step. Can you give a little bit of just a kind of step-by-step, very practically, so somebody's listening to this, they're interested, they've heard about it, but they don't quite know how to access this. Can you walk us through it in 60 seconds, right? Like, how do you do it? Where do you go? You're muted, I think.
I can jump in while Mary Beth is getting back online. For specifically the Paycheck Protection Program, the CARES Act delegated the authority to make lending determinations to SBA approved lenders to try and get these funds out faster. So if you are looking for the Paycheck Protection Program, you go directly, start with your lender. Many banks, because of the significant number of interested parties, are limiting new applications to existing bank account holders. So start with your existing bank, determine whether they are have become an SBA Paycheck Protection Program lender, and start there. If you're looking for some of the other programs, the Economic Injury Disaster Loan, the EIDL, you have to first establish your eligibility with SBA and then go to a lender. The SBA Express Loan Program also has delegated authority to SBA approved lenders. So in most cases, what you'll be looking for is going to your lenders. The Treasury Department also, they have not yet implemented their program, but in that case, you'd probably have to go to Treasury Department or a different set of lenders for it. But most of you applying for the PPP program would want to go directly to your lenders. And I would just add one addition to Nicole's answer to the question before about nonprofits. 501c3s and 501c19s are eligible for the PPP program. So it is not, there are some nonprofits which can apply.
And I'm sorry, I realized I didn't answer the question. There was one I know, Michael, you asked, but I didn't answer. So it was about the tax provision. So a lot of them key off whether you're an employee or don't have employees. Whether you're an employer. Some of them, as you saw, were size-based, but they are generally available for nonprofits who have employees.
Some of the questions we've received through the system, are there any restrictions on executive compensation in connection with the PPP loans?
Yes, the answer to that is yes. So when you are calculating your average monthly payroll for purposes of setting the loan amount, you are going to only count the first $100,000 of an employee's salary if that employee makes over $100,000. So that's the first. The second is when you are calculating the loan forgiveness period, you exclude entirely from that count any employees that make over $100,000. So those are the comp limits, if you will, for the PPP loan program.
And the one thing, this is Joel, that I would add is that on the Treasury Department's lending facility, so separate from the small business, but on the Treasury side, there are express limits on if you accept a Treasury loan, that you have to limit how much you pay executives during the term of the loan, and in some cases, extending beyond the loan. So on SBA, as Mary Beth mentioned, there's limits on how much you can calculate and how much you can spend towards executive compensation of the first 100,000. But on Treasury, if you do decide to go down the Treasury route, it expressly says there are limits to how much you can pay the person.
Another question. it's a little bit longer. So if an employer receives the PPP, terminates employees during the covered period, do severance payments count as eligible use for, quote, payroll purposes, especially in light of the 25% threshold?
Right. If you're paying severance, my belief is that it does count in payroll calculation. I believe that was in one of the guidance documents that were issued recently. So you would be able to include, right? But the thing you have to worry about too is the comparison of the date you got your loan to, the day 8 weeks later includes both revenue and number of employees. So you would have a different number of employees, a lower number of employees at the end of the 8-week period, and that would affect the amount of forgiveness of the loan. You wouldn't get 100%, you'd get some percentage of that.
And by that, thank you. And is there any difference? Some of our companies, members of ARM, are publicly traded. Some of them are privately held. I know, Mary Beth, you talked a little bit about the VC control issue. Does that play a role at all in any of these programs?
It should not. There is nothing that specifically prohibits publicly traded companies from applying for the SBA loans. The only thing is that if the stock is so widely held that you can't determine who would be, in essence, the owner, who has the majority share, then I believe that the board of directors are considered the ones that control the company.
Okay. Another question we got is just to confirm that the $100,000, when we're talking about the $100,000 loans, that's salary, or that's salary plus benefits?
It's salary plus benefits. So you would have your group health in there. FMLA, things like that would be included in the comp package.
But they're included for payroll costs, but the limitation on highly compensated individuals, the 100,000 limitation is on your cash payments, so your salaries, wages, and commissions. So you can count the first 100,000 salary, wages, or commissions towards their towards payroll costs, but that you can also have for that individual healthcare costs and other costs that would, if you put a cash value on that, would exceed 100,000. But there was a Q&A that was released last night that said specifically the limitation on the 100,000 to go into that payroll calculation that Mary Beth was mentioning would only be for applied to the salary, wages, and commissions.
And then the last question, I think, so I do want to say that the panelists are certainly available for follow-up. So I know we only had an hour or so. I think we have to take just one more, which is, can you take the loan? You talked about that you have to be a U.S. company. Can you take the loans as a U.S. company, but you do use the money to do development of product outside the U.S.? So many biotech companies, for example, do manufacturing or clinical trials outside of the U.S. Can you use, is there any restriction on the use of this money for doing the work overseas?
Well, I think there are two things. One is that the loan amounts are limited, right? You can only use them for payroll, mortgage, rent, and utilities. So that may take out some R&D activities. The payments are also supposed to be given just to U.S. employees. So I think that would take the foreign work out of the mix as well.
Okay. Well, I know we're getting close to the top of the hour. I'm going to turn it back over to Janet. for some closing thoughts, but thanks very much to Nicole, Mary Beth, and Joel for a great presentation today. Janet? You're
Thank
mute,
you,
I think.
Michael. Yeah. Thank you very much. I just wanted to extend my thanks too to the panelists and also the participants, and let folks know that in addition to this webinar, we have another webinar scheduled for Friday at 10 a.m. Eastern Time with two senior officials from the FDA who are going to present on the FDA's guidance about clinical trial conduct during COVID-19. They'll walk through, they've updated their guidance a few times already. They'll walk through the key components of the latest guidance on protocol changes, and then, as here, be available for questions and answers. So with that, let me thank you all very much. As Michael said, if you had questions that we didn't have a chance to answer and would very much like to be answered, please feel free to send them to me. I'm J. Lambert at alliancerm.org, or any of the panelists that you saw. We shared their contact information with you at the beginning, and we'll try to get those answered for you. Thank you very much. Thanks to our panelists. Have a good day, all.
Thank you.